What if I told you? Most traders don't lose money because they're wrong. They lose because they don't know how far price can actually go. They exit too early or hold too long. And the market punishes both. But today, I'm going to show you a simple concept that can help you predict targets, control risk, and avoid emotional trading completely. This is called the measured move. Let's be honest. You've probably experienced this. You close a winning trade early, and then price keeps running without you, or you take a loss. And seconds later, the market reverses. Or worse, you enter a trade, and it just goes nowhere. That's not bad luck. That's lack of structure. Because without a system, you're trading emotions, not probabilities. Now here's the key idea. Markets don't move randomly. They move in waves. Each wave has a rhythm. And here's the powerful part. The first move of the day often sets the blueprint for the next moves. This is what traders call a measured move. In simple words, measure the first strong move and expect similar-sized moves later. It's not magic, it's structure. Let's break it down step by step. Step 1. Wait. Never trade the first 15 minutes. That's chaos. Let the market settle. Step 2. Measure the opening range. Take the first move from lowest point to highest point. Let's say the price moves $5. That becomes your measured move. Step 3. Wait for consolidation. Price will slow down, move sideways. This is where most traders get confused. But this is where professionals prepare. Step 4. Trade the breakout. When price breaks out, you enter. You target the same $5 move. You control risk around 30%. That's it. No guessing, no emotions, just execution. Here's why this strategy is so powerful. You know your target before entering. You know your risk before clicking buy. You avoid random trades completely. And most importantly, you stop asking, should I exit now? Because you already know the answer. Now listen carefully. This is not about winning every trade. Some trades will fail. Some will stop out. But the difference is, you're no longer trading blindly. You're trading with a plan. And over time, that's what creates consistency. The goal is not to predict the market. The goal is to be prepared for it, because in trading, consistency beats luck every single time.